equity markets, and amid the extreme volatility in the markets, investor sentiment has of course been the worst hit. The valuation difference between the index stocks and their smaller peers have narrowed significantly, and fund managers are reworking their portfolios with respect to rising risk in the marketplace. Rhythm this of Morgan Stanley doles out some tips to investors on how to position themselves, what sectors to look into, what stocks to buy. Here he is in conversation with Neeraj.
The mid-caps offer more value. They don't offer the obvious advantages of scale and balance sheet. The large caps, putting those on the table. So we like, actually, I think in a portfolio you can have both. So I'm not distinguishing too much between large and mid, large and small, or large and mid. I think both the subsectors have merit in investment.
But IT as a whole, the entire theme, you believe the basket would benefit broadly. Okay, the other bit is on infrastructure, and it's a wide basket again. I mean, there is road construction companies, there are companies which are operating in the port area, so on and so forth, and there are companies which cater to certain large areas like power as well. What within the infra space do you find favorite?
I think infrastructure, generally speaking, is looking good value at these levels. So I'm not distinguishing between these various aspects of infrastructure. I think the utilities, if you're mixing it up with the utilities, those I think are avoidable. Okay, because I think there are some big problems there with respect to the PPAs and with respect to coal supply. So I think those are probably avoidable. But companies that are engaged in construction of power plants are okay. I mean, those I think should do well. Companies that are engaged in construction of roads, I think look quite good. So I'm more interested in the companies that are building infrastructure rather than operating infrastructure. So I think utilities are operating power plants. So those are less attractive to me. What I'm interested in is the guys who are actually building the stuff, because really the juice is in the guys who are building it, and that's where I think there could be momentum coming back.
And the interest rate cut cycle, if it does come about, adds that bit of vigor to some of these road.
Well, that helps both actually, but that helps the owners more than the builders.
Okay.
So the owners, they are the ones who finance projects. So the owners of infrastructure benefit more.
But you're not playing it because of the interest rate.
No, I'm not playing it for that. I'm not playing it for that. I think the rate sensitive we want to buy is discretionary urban consumption.
Okay.
Rather than sorry?
Not banks.
Banks, we are actually still underweight on banks. But I'll distinguish there between public and private sector.
Okay.
So I think we still like the private sector banks. So I think you can buy private sector banks, but I think the public sector banks still have to go through a little bit of pain on the NPLs front. So that needs to actually turn around for them. So maybe it's a little too early to go to them. The stocks have done very well, so I think they probably want to be avoided right now.
Just a short-term question actually before we again focus on the long term. Last quarter, the banking results surprised one and all by virtue of how they performed, because a lot of people were expecting some big negatives to come out, and that didn't happen. You think the quarterly earnings performance from banking would probably stay at an uptick and at a good level, or you think that there could be alarm bells by virtue of some NPAs rearing their ugly head in this quarter or possibly the next quarter as well?
See, I'm not an expert on banking, but if I were to just do a very broad brush analysis on the earnings, they surprised because NIMs expanded, not because NPL progression stopped.